mentioned with the Shared Concepts Group, we're going to start on time today, hopefully at 10 o'clock, and it's our intention to wrap up within 1 hour and be finished by 11 o'clock. I'm joined today by my two partners, Larry Strelecki and Jerry Howell, and we're hoping to go through the State of the Markets presentation to kind of give an overview of 2015 and an outlook for 2016. Every attendee is in listen-only mode, which means that if you try to talk at us, unfortunately, we won't hear you. There's two ways that you can listen in. You may have dialed in, which is fine, but you'll also notice that the speakers on your computer system will probably work as well, and you may be getting an echo because you may be hearing us both through your phone and your speaker. So if you want to disconnect your phone and listen just to the speaker, that should work just fine. If you wanted to ask any questions, you'll notice on the left-hand side of the presentation, there is a chat box, and in the very bottom of that chat box, there is a place for you to enter your question or type in a question and click the send button, and that will come to us in a private mode, and we'll be able to answer those questions for you at that time. And so if anybody has any questions right now, they can try that out. Otherwise, we'll get started with the presentation. If you do have questions, as I mentioned, just go ahead and feel free to ask them, and we would be glad to interrupt throughout the presentation to answer those questions that you have at the particular time. I need to show this slide, which is the formalities. Identifies us as a securities and investment advisory firm through SEC. Most of the data that we've got was collected from sources, and it's deemed to be reliable, and nothing we say today should be construed as investment advice. And if you have any questions about those disclosures, of course, feel free to give us a call. And I'm going to turn the presentation over to Jerry Howell, who's going to get us started, and then I'll be back to join you guys later, as will Larry. Thank you.
Good morning. Our goal today is to educate you about some of the factors we and the world financial analysts are watching. While it would be impossible for us to cover everything, we will try to touch on the most relevant factors. And while past performance provides no guarantee of future results, we can pick up on trends to help guide the decision-making process when investing. Here's what we're going to talk about today. Putting 2015 into perspective, factors affecting the stock market in 2015, and 2016's forecast. Today, let's take a look at a snapshot of how the S&P 500 performed last year. For the year, the S&P 500 ended basically flat, losing less than a percentage point over the whole year. In the first couple of weeks of 2016, stocks fell again, causing the S&P 500 to drop nearly 8%. That's frustrating for stock investors, but I want to put that performance into perspective. First, since the worst days of the financial crisis, the S&P 500 has returned over 200% during a bull run that has lasted over 80 months. Is the bull run done? We'll discuss that later on in our presentation. Second, markets faced down a lot of challenges last year. We had a lot thrown at us in the form of slowdown in China, a slowdown in Europe, plummeting oil prices, terrorism, and more. The fact that the markets ended flat is actually fantastic and is a sign of a market resilience in the face of serious concerns. We saw a pullback in August when the S&P tumbled into correction territory. Why we didn't freak out? Because corrections are normal and a healthy part of a market dynamics. We've seen more of that at the beginning of 2016. Why might that be? A couple of reasons. One, many of the issues that markets struggled with in 2015 are still with us. Two, volatility events tend to cluster, which is another reason why we're not surprised to see high levels of volatility going into 2016. We'll talk more about some of the factors affecting markets later on in the presentation. In the last chart, we saw that stocks didn't have a great year in 2015. However, we need to put that into the context of the challenges that markets faced down. Did 2015 meet expectations? Let's take a look at this chart here, which shows the performance through December 23rd of 2015 of 17 different asset classes, ranging from U.S. equities and international equities to fixed income and commodities. Right off the bat, we can see on the far left that commodities were big losers last year. Emerging market stocks and high-yield bonds didn't fare much better in the rising interest rate environment. On the far right, we can see that growth stocks performed reasonably well given the headwinds markets faced. To refresh memory, growth stocks are shares of companies that are expected to grow at an above average rate. One of their benefits is that high growth companies seek to achieve their goals despite challenging economic conditions. Now, that's not to say that they always accomplish those goals. However, 2015 was a decent year. One of the many reasons why we stress diversification so much is because of years like 2015, where asset classes and sectors achieve varying results. What was up last year may be down this year. That's how markets are. So what's the big takeaway from this chart? Though the S&P 500 ended the year flat, you can see there were many different winners and losers. Again, markets faced down a lot of challenges last year, but markets didn't go off the rails. That's a win in my book. Now, let's move on to talking about some of the factors that contributed to stock market performance in 2015. Markets got off to a rocky start at the beginning of 2015, and that volatility followed us for most of the year. In January, stocks slid back from their year-end highs on worries about global economic growth. Markets had a rocky spring because of the continued worries about the global economy, but reached a record high in May before pulling back in June on worries about Greek debt default. After creeping upward, markets plummeted by over 11% in August when China shocked the world by devaluing its currency. The devaluation was widely seen as a mission that the world's second largest economy was in trouble, and investors reacted by hitting the eject button. Weak oil prices also helped the correction along by fueling fears about a global slowdown. However, stocks didn't stay down long. By November, the S&P 500 peaked with close to record highs again before giving to jitters about oil prices and the Federal Reserve interest rate hike. What's the takeaway here? Today's stock markets are volatile, and intra-year declines are quite normal. Even when it feels like the sky is falling, it is important not to panic. Sit down, take stock of what's actually happened in the financial markets, and make prudent adjustments where necessary. We'll take a bit more about corrections and declines later in today's presentation. Let's talk about oil. You may have seen a lot of headlines last year about how low and volatile oil prices affected markets. Isn't cheap oil a good thing? Well, there are some pros and cons to low oil prices. For U.S. consumers, cheap oil translates into cost savings across the board. Cheaper gasoline, which is a big break for Americans, also makes it cheaper to put products on shelves and lowers manufacturing costs. These cost savings help keep inflation in check and may continue to put money in folks' pocket in 2016. From a high of $3.713 in April of 2014, gas prices plummeted over 45% to $2.02 in late December 2015. To put that in perspective, that's more than $2 per gallon lower than $4.11 a gallon Americans were paying in July of 2008. On average, Americans spend over $2,000 per year on gas. The drop in pump prices put money back in consumers' wallets, giving them more to spend in other areas like cars, electronics, and consumer goods. On the flip side, oil prices hurt energy producers like oil companies, who have been forced to shut down many oil projects in the face of historic lows. Between December of 2014 and December of 2015, the number of U.S. drilling rigs fell by over 60%. The negative impact of low oil prices can also be seen in construction, engineering, and other industries associated with oil and gas production. Domestically, the economies of big oil-producing states like Oklahoma, Texas, and North Dakota have been impacted by layoffs and revenue losses from closed-down projects. We see that pain in the performance of the energy sector, which we can see in the chart on the slide, dragged for most of 2015. The effects of cheap oil are also felt in the alternative energy sector, since consumers no longer feel the need to seek out alternatives to expensive fuel fossils. For countries that depend on oil for revenue, lower prices hurt the economy and may raise geopolitical risks in the Middle East and other areas. The Federal Reserve also played a big role last year. After months of anticipation, the Federal Reserve finally raised in December for the first time since 2006. Why did the Fed raise rates? Because it believes the economy is doing well enough to return to normal interest rate policy. See, the Fed has two mandates: low unemployment and stable inflation. Unemployment has been hovering around 5% for months, and the economy is doing well, reasonably well. Now that economic activity is picking up, the Fed has to worry about inflation overheating. The Fed delayed a rate hike for several months because of international growth concerns. While many of these concerns remain, the Fed is confident enough in the economy's recovery to start raising rates above zero. How much did the Fed rate? After all the fuss, rates went up just 0.25% after it's been held near zero since June of 2008. We don't know what the Fed will decide to do this year about rates. We know that policymakers are watching the data very carefully. The numbers on the right side of the chart show Wall Street projects for where rates will be over the next 2 years. We can see that by December 2016, rates are projected to be up to 1.1% and maybe up to 2.2% by the end of 2017. Compare that to where rates stood in June of 2007. Big difference. Now, that's not to say that we're not keeping an eye on how rates will affect markets this year. Higher rates will ripple across the economy in the form of higher mortgage and loan rates, higher credit card APRs, and higher rates on bonds and other fixed income investments. While the United States continues to see economic improvement, the story is quite different in many emerging market countries. Countries like Brazil, Mexico, and Turkey are struggling with slowing growth, rising interest rates, corrupt governments, terrorism, and other issues. Low commodity prices affect countries that depend on sales of oil, copper, and natural gas to power their economies. Slowing growth in China affected countries that depend on exports to the world's second largest economy. A strong dollar means weaker currencies relative to the dollar. While that's good news for countries that sell a lot of exports because it makes their goods cheaper, it's a double-edged sword. Many of these countries borrowed money in U.S. dollars and will have a hard time paying off in the increasingly expensive debt. The debt issue is compounded by rising interest rates. Higher rates have historically made the dollar stronger and will make borrowing more expensive for emerging market countries. We know that 2015 was a bad year for terrorism. Violence in places like Iraq, Afghanistan, Syria, and Nigeria spilled over, and we had several terrible high-profile incidents in major cities like Paris. This chart shows the number of reported terrorist attacks around the world in 2014. We don't have data for 2015 yet, but statistics show that between 2013 and 2014, the global number of deaths from terrorism increased by 80%. Let's take a moment to think about that. It's terrible that we live in a time and a place where terrorist incidents happen on a regular basis, and we can probably assume that terrorism isn't going away anytime soon. In fact, it's something that we may be dealing with for many years to come. However, as Americans, we are incredibly fortunate. You can see by the chart that the vast majority of incidents happen in the Middle East and North Africa. North America is incredibly lucky to experience relatively few incidents, but it's important to think about worst-case scenarios. So let's think about how a major terrorist incident could affect the economy and markets. I'm going to introduce a term here that some of you may have heard before, black swan event. A black swan is an unpredictable or unforeseen event that can have extreme consequences for markets. The mortgage meltdown was a black swan event. The fall of the Soviet Union was a black swan. September 11th was a black swan event. September 11th was the first terrorist event in U.S. history, and it struck down Manhattan, just blocks away from the New York Stock Exchange. The market didn't reopen until September 17th. From the beginning of September to the market bottom on September 21st, the S&P 500 lost 14.75%, putting it firmly in correction territory. However, markets didn't stay down by the end of 2001. The S&P was up again by nearly 19%. Can that path predict the future? No, but we can use it as a guide. The point is that even a major terrorist event would not necessarily spell disaster for a market. At this point, I'm going to turn this over to Dave Schlossberger to continue on with the presentation. Thank you.
Hey, everybody. Thank you, Jerry. So I'm going to start off by talking about China. China was one of 2015's biggest stories. They had a GDP growth near double digits or in excess of double digits in 2010, and that GDP growth has been slowing considerably. Because of the GDP growth, China decided to devalue the yuan in hopes to increase its exports. If it makes the yuan less expensive, it makes China products less expensive to buy, and hoping that that would spur the economy. But we can see from the projections going forward that China's GDP is expected to be in the mid-sixes, which is a paltry decline from the 10.6 that they had in 2010. We should put that in perspective in that the U.S.'s GDP has been hovering around 2% year over year. And so I think that we would be very thankful to have a 6% GDP growth. But nonetheless, it is an economy that was used to that kind of growth. and it's feeling the impact of that slowdown. If we look throughout Europe, Europe also struggled with anemic growth through last year. The U.S. has made some strides in addressing its economic issues. Still, despite that, countries like Italy, Spain, and Greece haven't yet recovered from the financial crisis. And though economic growth is slowly coming back, those political crises around Greece and the refugee issue are hampering the way forward. Europe also lacks confidence in its recovery and is thinking of doing a similar type of infusion of monies like we did the QE issues here in the United States. You can see on this map that some countries have been affected more than others. Germany, for example, has experienced declines in exports due to waning demand in China. However, despite the challenges, Europe's economy is in its third year of recovery, and policymakers do expect 2016 to see more modest growth. As you can see on the map, only a small handful of countries will see growth in the 3 and 4% range. However, again, keeping that in perspective, that would be in excess of our anticipated growth. Most EU countries will see slower growth, and only Greece is expected to be in negative territory for 2016. If we take a look at the Consumer Sentiment Index as published by the University of Michigan, we can see highs and lows of the Consumer Sentiment Index. And that's thought to be an important indicator because the more we are in the economy as consumers, the more likely we are to spend, especially excess dollars that wind up in our pocket from reduced gasoline prices. And since 2/3 of our economic growth is based on consumer spending, one would think if you have a high confidence, you would see a great amount of growth. But that doesn't always turn out to be the case. If we look at the bullet points in the bottom of the chart, like here, we'll see in October of 1990 that the Consumer Sentiment Index was relatively low, way below average. And the percentage number shown below that is the percent that the market grew over the next 12 months. So the S&P had a 29% growth in the 12 months following October of 1990. And if we take a look at all of those growth rates following the lower bullet points there, we'll see that we often experience double-digit S&P returns following a low consumer confidence level. And if we look at the top of the chart, we'll see that we didn't often experience double-digit returns in the market following high consumer confidence. So there appears to be a little bit of a disconnect between where our confidence level is and where the market might go. There's a lot of economists that would put a lot of weight in the consumer sentiment. However, sometimes it's hard to kind of tie expectations based on one gauge or another. And so it's nice that consumer confidence is high, but if that doesn't turn into spending to help grow our economy, then we may not see the types of returns that we're hopeful to have in 2016. Inflation is another factor that can impact our economic well-being. Although the relationship between inflation and the stock market is complex, all things being equal, a stable, modest inflation is better for equities than high or volatile inflation. In the middle of the chart, a couple of acronyms. CPI stands for Consumer Price Index, and the headline CPI is the most popular measure of inflation. It's put out by the federal government, and it tracks prices in the large number of goods bought and sold in the United States. The core CPI strips out the volatile food and fuel prices to try to focus more on long-term inflationary trends. You can see by the light blue line jumps around much more than the darker blue core CPI. So the core CPI is going to give a more representation of inflation, and the light blue headline CPI is going to have volatility because of food and energy. As of November of 2015, the headline CPI was well below the 50-year average at 2%, and the Fed expects it to stay modest in the months to come, as Jerry already mentioned, which is good news for economic growth. And though the past doesn't always reflect the future, historically a sudden run-up in prices has often been accompanied by a recession, That being the case, we're pretty confident that the Fed is going to be relatively slow about raising the interest rates. Actually, we can see the gray bars in this chart represent recessionary periods, and we can see that the recessionary periods have almost always been accompanied by some sort of run-up in inflation. And not necessarily that the run-up has exceeded the average, but that there had been a run-up in inflation during the recessionary period. So now that we've mentioned a few things about 2015 and tried to maybe put an idea on where some of our challenges in 2015 came from, let's take a look at what the forecasts are for 2016. There's a number of advisors here or strategists with a variety of firms that have put out their target growth rate for the S&P for 2016 and where they expect the S&P to end up at the end of the year. The average of those economists is 2,193, which would represent a 7% growth rate. Sometimes we may rely on the economists too much and the news clutters us a bit. I remember when we did this very same presentation called the halftime report last year, we showed a very similar chart. And that chart, at the beginning of the year, the economists expected a 6 to 7% growth. At the midway point in the year when we did our presentation, the market was relatively flat, and the economists restated their expectation of 7% for the remainder of 2015, or looking for that 7% growth to happen in the back half of the year. And of course, that didn't happen. So that just suggests that while we want to filter the information that we rely on these experts, they don't have a crystal ball either. And we really need to take all the data into account when we come up with expectations. This chart will show a forecast about the future by using 10 leading indicators. And those leading indicators are shown in the box in the middle of the screen between 2006 and 2002 and 2006, and it shows whether or not those indicators are uptrending, downtrending, or neutral. On the basis of those indicators on a composite basis, we have the lines that represent on a quarter-by-quarter basis where those expectations are, and we can see that the expectations are, most of the indicators are in positive territory or trending upwards presently. We see that they started trending downwards at the middle of 06 or the end of 06 and into 07. And then came the blue bar, which represents a recession. We see also in the early stages of 2000, it dipped into negative territory, and we saw a recession there as well. So if we look at where the green bars presently stand as of December of last year, of 2015, we're well in positive territory with the ranking being 4% to the positive. And it would take perhaps a little while before that might dip. All this to say that a recession is not predicted for the near future. The picture is less than perfect. Things could be better. And we see that a strong U.S. dollar is weighed on the manufacturing sector, and that unemployment claims are still higher than we like. However, other areas of the economy are still performing well. According to the conference board that made up this chart and is doing these measuring, the group that created this composite LEI, which is leading economic indicator chart, the economy remains resilient, though expectations are moderate. That's their quote. The economy remains resilient, though expectations are moderate. And please feel free to interject any questions as we go along by typing them in the box on the bottom left if you have any. If we look at the interest rate forecast, interest rates are going to play a major role in 2016, although the Fed seems likely to continue to raise rates this year and steady. This table shows the forecast that's created by the Fed Reserve of where it expects certain key metrics to be in the next few years. And I do want to draw your attention to federal funds rates. That's the interest rate that the Fed controls and plays a big part in determining interest rates throughout the U.S. At the end of 2015, the Fed raised the target rate to 0.4%. By the end of 16, it anticipates raising those rates another 1% to 1.4%. Now, if we compare that to the long run rate of 3.5% on the far right, we're talking about baby steps here. And predictability is key to avoiding a market overreaction. And in our opinion, the Fed's been doing a great job of telegraphing its plays and giving the investors time to adjust to these future changes. The Fed also expects the economy to grow at a nice, steady pace, not too hot, not too cold. Are investors right to worry about interest rate hikes? Well, history suggests probably not. To put things in perspective, we want to consider what the S&P 500 returned over other post-rate hike periods, according to the U.S. 2016 Outlook Research Report published by UBS. On average, the S&P 500 returned over 33% after the first rate hike. While past returns are by no means a guarantee of future results, we can clearly see from these examples that interest rate hikes don't necessarily mean calamity for equity. Contrary to what some naysayers would have you believe, equity markets have fared well following interest rate hikes. And we'll share more specific forecasts about the markets with you in a tiny bit when Larry gets to his part of the presentation. Another indicator that experts are looking at is where the stock market is. Stocks have been hovering near historic highs for some time. On May 21st of last year, the S&P reached a new record close of 2130.82, and it spent over 75% of the year within 5% of that high. So you may have heard a number of pundits talking about the dangers of reaching all-time highs in the stock market and how the rally can't be sustained at these new levels. However, if you look at long-term trends, you can see from 2000 to about 2010, the S&P was largely flat. That's more than 10 years without any significant growth because it took us a long time to dig ourselves out of those two bear markets, the ones that occurred in the early 2000s and the 2008 market. The market did experience the same pattern of flatness between 37 and 48, and again between 66 and 74. So what happened after those plateaus? The market experienced extended periods of growth. So we can't predict the future, and we won't tell you that there aren't significant headwinds facing the market this year. However, the historical pattern is one of plateaus followed by some breakout growth, and we can add that to our pro column for stock market growth this year, or a pro con. If we look at this chart, we'll see year by year where the market ended up in the green bar. So in 2008, the market was down 38%. 2009, the market was up 23%. In 2010, it was up 13%, etc. The red numbers represent the worst drawdown throughout that calendar year. So what that tells us is that even when the market is up, we can expect intra-year declines, or we could expect declines through that period of time. Look, for example, at 2009, when the market ended the year up 23%, but in that year, it had experienced a 28% loss within the year. Or in 2010, when the market was up 13%, and it experienced an intra-year decline of 16%. All that to say is that in good growth years, we're going to experience some drawdown, and that drawdown is normal. That's to be expected. And so we really should look at that. In fact, the S&P 500 has experienced average intra-year declines of 14.2%, all the way dating back to 1980. And despite those declines, the annual returns were still positive in 27 out of 36 of the years. That's 75% of the years we end the year up, 25% of the years we end the year down, but every single year we've had a decline at some point through the year. So intra-year declines are normal, and that is not the new normal, that's the long-term normal. We should be familiar with that. So the obvious question is a bear market coming? And CNN has created this chart that takes a lot of indicators into account. They call it the Fear and Greed Index. and it tries to explain whether or not fear or greed is driving the market. So is a bear market coming? That's the trillion-dollar question. So let's talk about the difference between a bear market and a correction. By definition, pullbacks are dips of at least 5% from a recent high. Corrections are dips of at least 10% from a high. As we saw in the previous chart, pullbacks and corrections happen with some frequency, and we typically view them as short-term blips that can offer us buying opportunities or offer our mutual fund managers buying opportunities on our behalf. Bear markets are corrections of 20% or more and are usually represent a sustained period of pessimism. Those are more concerning because it can take quite a while to come back from a bear market. So we saw several pullbacks and one major correction last year, but no bull market. Does that mean that a continuation of the bull market is guaranteed? Well, of course not. Volatility is all but certain this year, and we're facing serious headwinds. However, we're not seeing the excessive valuations or irrational exuberance or indicators of a recession that we might expect to see at the end of a bull run. Though we expect to see continued volatility in 2016 and aren't ruling out pullbacks or possibly another correction, we aren't seeing the overheated market sentiment that often begins a bear market. Two emotions drive investor sentiment: fear and greed. This chart is a composite indicator put together by CNN to gauge how investors are feeling. At the end of December, sentiment was stuck in neutral. That means that investors aren't feeling particularly greedy, nor are they feeling particularly fearful. They're just sitting tight and waiting for more information. That means that investors aren't feeling too bullish nor too bearish. So here's a quote by Thomas Lee. The stock market and the economy doesn't always move in tandem, but over the long term, stock market performance will tend to mirror the economy. And while some folks out there are predicting an end to the bull market, we don't think it's going to end this year. And here's why this quote. Lee stating a fact that historically, bull markets that have lasted at least 4 years, since 1897, have only ended with a recession. That is, they typically do not end just because everyone is too bullish. And the good news is the sentiment is relatively neutral. We're not too bullish and we're not too bearish, and we don't forecast a recession coming anytime soon. So with that, I'm going to turn it over to Larry, who's going to take the presentation home. Again, if you have any questions throughout the presentation, please feel free to note them in the chat box in the lower portion of the left side of your screen. Thank you.
Hello, everyone. This is Larry Spilecki, and so taking off from Dave. So if bear markets are often triggered by recessions, do we have to worry about a recession this year? What I'm going to do is take you on a little journey. We're going to take a look at 2008 as we went into our last recession, what the recovery started looking at like, and compare that to where we are now. And what you see in front of us is a dashboard of leading economic and financial indicators. The Dick Tracy decoder is pretty easy. The green side, we're positive. On the red side, we're in trouble. And if you see anything in yellow, it's just like a stoplight. There's a caution there. So as we take a look at this group of 20 indicators, we're currently right now, you see in January 2008, about 8 months before Lehman Brothers collapsed in September 2008. Now you note there's a fair number of yellow and red indicators long before the recession actually started. The economic outlook is negative, energy prices are rising, and the housing market is also a red flag. Going on to our next chart, we're going to take a look at July 2008. Again, months before the trouble started, note that the green is disappearing and more indicators are turning yellow, red and yellow. Now we're seeing job creation slow down, and the credit markets are starting to seize up. Okay, so now we're in December 2008. Lots of red on the board. Economy is in serious trouble. The housing market is deep in the red. Volatility is high. The global economic outlook is negative, and business spending is dropping. So this is a progression that we've seen from, looks like, in terms of the leading financial and economic indicators. Now, now let's,
I did it for you.
You did it for me.
No, I went too far.
Yeah. Technical difficulties. David and I are
This
both
technical
changing
difficulty called David Washburn.
Okay, now we're going to take a look at February 2010, 2008. Obviously, we were heading into the recession, February 2010. We're recovering, and it's a pretty different picture, right? At this point, there's a lot more positive pressures acting on the economy as we started digging ourselves out of the hole created by the financial crisis. The economic outlook is good. Monetary policy is helping, with the Fed lowering rates and pumping money into the financial system. Companies are also starting to feel more upbeat about their prospects. So this is what the recovery looks like. Now let's, whoops. Oh well, this is going to keep everybody on their toes. All right, so now let's take a look at December 2015 in terms of where we are now. You can see that we have some areas of concern in the next 3 to 6 months, and that would be the items in the yellow and the red. Analysts are worried about geopolitical risk like terrorism. They're also thinking about political battles in Washington that may harm the economy. The global economic outlook is also looking a little weak. However, we have a lot going for the economy as well. All this is to say that we don't see a lot of recession pressure the way we did back in 2008. Right now, the board's looking pretty green. And while the past can't predict the future, and financial markets don't always act in concert with the economy. However, barring unexpected economic shocks, in other words, something big and unknown, we're pretty confident we're not heading into a recession. Okay, we had some technical difficulties in terms of being able to hear me, but we're going to start out with, we're going to go back to the one chart over here on the plow horse economy. We're currently projecting GDP to grow somewhere in the 2.5% range, which has been defined by a lot of economists as a plow horse economy. Certainly not stellar and exuberant growth, but still very healthy for the nation as we go forward. Now let's take a look at how elections affect the stock market. Americans will spend a lot of time this year watching the presidential election race leading up to November, especially now that Donald Trump is in there and a lot more people are watching the primaries. Every time elections roll around, investors will ask, how will the election affect the stock market? What will happen if so-and-so winds up in the White House? Well, we can't predict the future, but we can take a look at some historical charts for perspective. All right, in this chart shows a history of election years between 1990 and the last presidential election in 2012. And there's a couple of takeaways associated from this. One, stocks tend to do pretty well in a presidential election year. On average, the Dow returns 7.4%, and that's pretty doggone good. And that's in your far left-hand column. The second point is that regardless of whether a Democrat or Republican won the election, stocks perform better when the incumbent party won. Why that is, I'll leave it up to you, and will that hold true this year with all of the gamesmanship that we're seeing? We don't know. So there's no prediction of the future, but at least if we take a look at past history, the elections will have a slightly positive effect on the market. Now, if we take a look at how do elections affect the stock market, this is kind of an interesting chart. It shows us how the S&P performed during the last 10 election years, and you can see that with the notable exception of 2000 and 2008, the S&P has delivered positive returns in election years since 1976. Let's remember that in 2000 we had the dot-com crash, and 2008 the financial crisis. All told, I think we can say that historically election years don't have much effect on overall returns. Now, that's not to say we won't see volatility and uncertainty in the period leading up to the election. That's probably a given, since the investors and the market hates uncertainty. Now, elections do have a profound effect on policy. There's a number of short and long-term issues that we hope Washington can help with. And if politicians don't work together to address issues like the national debt, Social Security, economic policy, and wage growth, then markets may suffer. We saw that during the fiscal cliff debacle and other periods of political gridlock. As a voter, focus on what's important to you and make decisions that resonate with your values and perspective. Now, as an investor, take several steps back from the rhetoric and the hype, and don't let them dictate your major financial decisions. If you pulled out of the markets in 2008 or 2009 because you were unhappy with the election, you'd have missed out on all the growth we have seen since then. Now, where do we go from here? The $64,000 question. I guess that kind of dates me right there. Anyway, let's take a look at some of the major trends that we have, and many of the experts we've consulted with are looking at this year. First, we'll take the negative side, because I think that's what we're mostly hearing. We're looking at economic slowdowns in China, Europe, Brazil, and other places around the world. We may have seen the worst already in China. However, we could see more evidence of a serious slowdown, which could spread around the world. Emerging markets will be hurting because of low oil prices, government debt tied to U.S. interest rates, weakening currencies, and other issues. They borrowed a lot of debt at low rates. What will happen when the rates go up and they're paying it back with U.S. currency? A strong dollar makes U.S. exports more expensive, which hurts U.S. companies that depend on foreign demand. We see that being an ongoing concern. Now, going to the Federal Reserve, they'll probably continue to raise rates. If they do so too quickly, it could put out the economy's flame, but the bet on Wall Street right now is that we will not have as many rate increases as they've projected. We're also thinking about terrorism and other potential black swan events that could throw a curveball at the economy. Now, if you take a look at, let's move over to the caution column. In the caution column are high equity valuations in the political environment, more specifically in the United States. This could cause problems, but won't necessarily be an issue this year. Now, turning to the positive side, because we want to balance this out, on the positive side, we believe that a strengthening labor market will continue to support economic growth. We're not expecting to see tremendous GDP growth this year. Instead, we think, always assuming the negatives don't take over, that we'll see a continuation of the plow horse economy, slow, steady growth. A stronger labor market should translate into wage growth, which will hopefully boost consumer spending. As long as inflation remains stable, it'll be an indicator of healthy economic growth. Now, in terms of developed Europe, the European Central Bank is trying to fuel growth in Europe through quantitative easing. We hope to see that puts Europe's economy back on track. Now, we want to prepare you for a couple of negatives that could arise. One, we talked about U.S. companies could experience weaker profit growth because of slower than expected economic growth. If that happens while U.S. wages are growing and interest rates are higher, corporate profits could get squeezed, and this could be a drag on the markets this year. Another negative scenario could occur if inflation ends up being higher than expected because of rising wages and job growth, and that could trigger more aggressive rate increases by the Federal Reserve. And as we said before, the black swan events that no one knows about right now are probably the biggest caution that we have going forward. So what do we do? Well, even though through this presentation is about 2015, I want to take a minute to talk about the pullback we experienced in January. During the first couple of weeks of the year, the markets dropped at more disappointing data out of China and continued weakness in oil prices. You remember that? Well, to some people, it doesn't feel like we're quite out of that. How did it feel? Even a lot stressful. Here's the thing. 2016 is going to be a volatile year. Some experts say that January sets the tone for the rest of the year. Maybe it does, maybe it doesn't. 60% of the time that January was negative, the year turned out to be positive market. So we don't have to crystal ball, but we'll see. I'll repeat what I said before. Corrections are a normal and natural part of the market cycle. According to research, the stock market experiences a correction about every year, and the average correction lasts about 14 calendar weeks. While we can't predict these corrections or their duration with any accuracy, here's what we can do about them. First of all, turn off the television and stop reading the stock market pages of your newspaper. Honestly, that's why you have a professional. We do the worrying for you, and we'll tell you what you need to know. You also just have to think back in terms of every time it looks like we're going to get a record snowfall and it's hyped up in the news and we end up with about a ½ inch of snow. So a lot of times it is sensationalized. Second, focus on your goals. Are you living comfortably? Can you afford the things you want? Corrections only matter to short-term investors who are jumping in and out of the markets. Remember what we saw on the chart at intra-year dips. They're a blip on the radar to long-term investors. Third, stay flexible and active. One of the benefits of working with us is that we stay on top of the markets and are constantly doing analysis to find opportunities to help our clients thrive during different market environments. Fourth, avoid making emotional decisions. Hitting the panic button during a decline is often the worst thing you can do. Periods of high growth frequently happen shortly after a pullback. If you're not in the market when it moves, you could miss out on the best days of performance. Just think about 2008 for those individuals that didn't have professional assistance and jumped out of the market and missed all of the recovery going forward because they were fearful of what the market would do. Finally, talk to us. If you're worried or have experienced life changes that affect your portfolio, we need to know about it. We want your first phone call whenever you're going through something that involves your finances, or if you're uncertain about your lifestyle and spending money this year, give us a call and we'll talk it through with you. Now let's take a look at some action items for 2016. First of all, here's some action items for you. Keep us in the loop with important life changes. If something changes in your life or a personal situation, let us know. Excuse me. We want to know about important family events like births and deaths. We also want to know about health issues, changes in your employment, any financial change like an inheritance that may change your situation. We also want to know about any changes in your feelings about risk and future goals and any concerns about the market environment. We also want to go over your estate documents, beneficiary designations, and other paperwork to make sure that it's all up to date. Now, what are we going to do for you? First of all, we're going to keep you informed through regular communication, and hopefully you're viewing this webcast as one of the events that we're doing to keep you informed as to what's happening in the financial world. We're going to manage your investments according to your personalized strategy, and we're going to stay on top of changes in the market environment and make prudent adjustments when necessary. Well, with that, I'll open it up to questions, and thank you for your time and attendance.
So there's one question out here. What are the Assured Concepts Group's expectations for 2016? And to answer that, it really depends on the expectations that you set with your advisor, because we do have a multitude of portfolios that you can be involved in. Your results will vary from client to client. And so the recommendation, if you have concerns about the expectations for 2016, I'll encourage you to call your advisor and set an appointment with them to discuss that, and we could go through that. Overall, we're cautiously optimistic. In some cases, there's been some adjustments to be a little bit more protective of the unknown, but in all cases, we're still optimistic. We haven't ducked and run, so to speak. We are filtering all the data that we get on your behalf and trying to determine which information is best to use and which is news that is just a scare tactic and we shouldn't pay much attention to. And we're doing that work through our meetings and through the data gathering processes that we have. And so if you want to go through any of that again, I just encourage you to call your advisor, and then hopefully the expectations will fit with what you're expecting for your growth goals and your goals in general. I'd like to thank everybody for calling in. That'll kind of wrap up the presentation at this time. As always, if you have any questions, feel free to call us at any time. This presentation will be posted on our website. So if you'd like to get a copy to anybody, you could forward a link. We'll send a link out to everybody that wasn't able to call in, and you'll be able to forward that if you need to or want to. And until next time, we thank you for joining us today. You guys have a great day. Bye-bye.